Hi everybody, I'm Dan Pilla. It's tax filing season. April 15th is coming up fast, and this is the time of year when information is flying everywhere. And friends, I don't want you to get in trouble by following bad advice. So I'm going to go through what I consider to be the top 10. There might even be more of them, but these are 10 that I could think of off the top of my head. Things that you need to know about myths, misinformation, and lies about the IRS and about tax compliance. So let's dig into them right now. All right, number 6 on my list is a myth that's been flying around for decades. And I talk about this very specifically and extensively in my book, Dan Pilla's Small Business Tax Guide, because it gets so many people in trouble. And this is the idea that you don't have to pay Social Security taxes on your income if you set yourself up as an S corporation. Friends, it's very important to understand that if you set yourself up as an S corporation and you are the shareholder and you are performing services for that corporation, the IRS requires you to draw a salary from the corporation that's commensurate with the fair market value of the services that you render. All right, so that means you have to put yourself on a salary. And when you're drawing a salary, friends, that salary is subject to Social Security tax, Medicare tax, just like any other salary. Plus the fact that the corporation, as the employer, now has to match the Social Security and the Medicare. You're not tax exempt on your profits just because you set yourself up as an S corporation. Now, it is also true, however, that you can draw certain dividends from your S corporation and not pay Social Security taxes on those dividends. But it's important to understand that the salary must come first, and the salary must be commensurate with the fair market value of the services that you render to the business. Next on my list, number 7 on my list of myths and misunderstanding and lies that go on about the Internal Revenue Service and tax law compliance during this tax filing season. And that is, if you operate your business as a trust, you don't owe taxes. Friends, there's an entire industry out there that preys on the ignorance of taxpayers when it comes to the use of trusts. Trusts are a very important tool for estate planning. They are a very poor tool for business tax planning. All right, trusts are good for estate planning. They're bad for business planning. And just because you set yourself up as a trust does not mean you are tax exempt. Trusts are subject to federal income taxes, just like a corporation, just like a partnership, just like a sole proprietorship. It doesn't make any difference. So don't fall for the myth that says trusts are not subject to paying taxes, because it is just simply not true. Number 8 on my list is the common misunderstanding that says if you sell your principal residence, the house you live in, with yourself, your spouse, and your family, if you sell that, then you have to buy a new house within a certain period of time or your profits are taxed. That is not true. Not only is that not true, it hasn't been true for at least 20 years. What the law is right now is that if you sell your main home, you have the right to exclude a certain portion of gain from taxable income. In other words, you can sell your house tax-free within certain limits. If you are married filing jointly, you can exclude up to $500,000 of profit from the sale of your main home. That is to say, you pocket $500,000 of profit free of tax. If you're a single person, you can pocket up to $250,000 of gain on the sale of your home. So let me illustrate how this might work. Suppose you're a married couple filing a joint tax return. Suppose you bought a house 20 years ago for $300,000 and you sell it today for $600,000 and you downsize into an apartment or a condo. Okay, fine. If you bought it for $300,000 and sold it for $600,000, your profit is $300,000. Because the exclusion for married filing jointly is $500,000, you don't have to pay a dime on that profit, and you do not have to roll the proceeds over into another house. You don't have to do it. Number 9 on my list is another very, very common misunderstanding that's come into vogue here in about the last 10 years. And that is the idea that if you set yourself up as an LLC, then you get more deductions for that LLC than any other business form would give you. And that's just simply not true. Not only is it not true, it's grounded on a fundamental misunderstanding of what an LLC is and how it works in the first place. An LLC is called a limited liability company. An LLC is created under state law. State State law controls the creation of an LLC. The IRS does not. The IRS has nothing to do with LLCs. And as a matter of fact, friends, as far as the IRS is concerned, an LLC is referred to as a disregarded entity. What does that mean? Does it mean the LLC is illegal? No, it doesn't mean that. LLCs are not illegal. They're perfectly legal. They're 100% proper, no question about that. The only thing is this. An LLC is a relatively new creation in state law, and it's been around for maybe 15 or more years approximately, but not that long. So what that means is Congress did not set up a separate taxing scheme to cover LLCs. So as far as the IRS is concerned, if you're an LLC, you have to make an election of how you're going to be taxed. An LLC is taxed either as a sole proprietorship, a partnership, or a corporation, depending on the nature of the LLC. And you have to make that election as a taxpayer. I talk about this at length in my book, Dan Pilla's Small Business Tax Guide, because there is so much confusion about this issue. All right, so just because you're an LLC does not mean you get a whole family of tax deductions that aren't available to other business forms. That's just not true. Depending on how you're taxed, whether it's a sole proprietorship, partnership, or S corporation, depends on what types of deductions that you are able to claim. So you have to understand that the IRS is going to expect you to make an election as to how your LLC is going to be taxed. And if you don't make that election, which frankly most people don't because they don't know they're supposed to, right? It's a common mistake. If you don't make that election, then the default rules apply, which means that the IRS is going to cram down your throat rules that you might not necessarily want to live by. So understand, friends, that LLCs are not given favorable tax treatment just because of the name LLC. And number 10 on my list, and I don't mean to suggest, friends, that there's only 10 myths and 10 misunderstandings and 10 lies out there about the IRS and tax law compliance. There are dozens and dozens of them, and this is why it's so important for you to get my materials, Dan Pilla's Small Business Tax Guide, the IRS Problem Solver, How to Get Tax Amnesty, these various books that I've written specifically to help people stay out of trouble with the IRS. But number 10 on my list says, if I'm honest, I don't have to worry about the IRS. You know, I talk to people all the time about staying in compliance with the IRS and making sure that you have your records in place and that you're doing things correctly. And people tell me all the time, I hear this all the time, Dan, I don't have to worry about the IRS because I'm honest. Well, let me tell you, friends, being honest is not good enough. It is not good enough to simply be honest. Look at the fact of the matter is the overwhelming number of American people are honest when it comes to their tax returns. The fact is most people overpay their taxes. They pay too much in taxes precisely because they don't want to get sideways with the IRS. They don't know what their rights are. They don't know what their deductions are, and they don't want to get sideways. So they don't want to take a chance. I've heard people tell me 1,000 times, Dan, I'm not going to paint a target on my chest. I know I could claim this deduction or that deduction, but I don't want to because I'm afraid. Okay, well, that's fear. That's not dishonesty. But here's the thing you need to understand. Here's what's important. It doesn't matter to the IRS whether you're honest or not. They don't ever ask you the question, well, gee, Mr. Smith, are you honest? And you say, well, yeah, I'm honest. And the auditor says, oh, well, that's different. If you're honest, then we don't have anything to talk about. That's not how it works. The burden of proof is on you when it comes to dealing with the IRS. The IRS never has to prove you did it wrong. You have to prove you did it right. So it's not good enough to sit in front of a tax auditor and say, I'm honest, let me out of here, forget this whole thing. The tax auditor is going to say, you know what, you probably are honest. And in fact, I believe that you're honest. But you have to prove that you're entitled to these deductions. You have to prove that your tax return is correct. And if you can't prove your tax return is correct, guess what? They adjust it the way they want to adjust it, and you're stuck with the tax, interest, and penalties that grow from it. So it's not good enough to be honest. You have to know how to prove that your tax return is correct. Make no mistake about it, friends. If the IRS challenges you, whether in writing through a notice or face-to-face through a tax audit, the burden of proof is on you. And if you don't know how to carry that burden of proof, and frankly, almost nobody does, if you don't know how to carry that burden of proof, you're going to end up paying taxes you don't owe. Don't be victimized by this. Understand what your rights are. Understand what the limitations of the IRS are. Invest in my materials to help you understand what your compliance obligations are so you don't get sideways with the IRS. Go to my website, TaxHelpOnline.com. Do it now and get yourself set up so you're not victimized. And in the comments below, I want you to share with us the worst myth, the craziest bit of advice, the worst bit of information you've ever heard about IRS and tax law compliance. And let's share that so people understand how to stay out of trouble with the IRS.